Welcome to the Deep Dive. This is Talk Tickers, your essential analysis for experienced investors, taking a full stack of earnings call data and turning it into need-to-know insight.
Today, we are deep diving into the Q3 2025 earnings call for American Eagle Outfitters, or AEO. And this wasn't just, a modest beat. It was a powerful structural surprise that really sent shares rallying.
Right, it signaled exactly the inflection point that management has been guiding towards for a while.
Precisely.
Absolutely. The after-hours movement was immediate and very constructive. So the headline figures were undeniably strong. But for you, it's the structural evidence, the underlying health of the business that really matters most.
That's it. Let's start with that headline context there. GAAP diluted EPS landed at 53 cents.
53 cents. That's a substantial 29% increase year over year.
And maybe more importantly, it was a 10-cent beat against the 43-cent consensus. I mean, a 23% surprise on the bottom line.
Right.
That is not noise. It demands attention.
And that strength, it flowed directly from improved operational leverage, right? Revenue came in at what, 1.36 billion?
1.36 billion, yeah.
Yeah.
Marking 6% year-over-year growth, and again, comfortably beating the consensus of 1.32 billion.
But the real proof of health, the number the market was really watching, was the acceleration in comparable sales.
Yes. Total comps were up 4% overall. This is the operational signpost everyone was waiting for, especially coming off a 1% decline in the prior quarter.
So that jump really confirmed the turnaround strategy is gaining some serious traction.
Yeah, it really is.
Okay, so if the 4% comp acceleration is the signpost, the divergence between the two main brands, that has to be the map guiding the growth. Let's talk about this tale of two brands dynamic.
Aerie just continues its exceptional run. It delivered double-digit growth with an 11% comparable sales increase.
11%. And this wasn't just like one hot item, right?
Not at all. That strength was consistent across intimates, apparel, sleepwear, and the offline activewear segment. It was firing on all cylinders.
And management was pretty clear that they see Aerie as having this massive long runway. It's important to remember Aerie and Offline are still under $2 billion in revenue combined.
And less than 5% market share. For a brand delivering 11% comps, that market share stat it screams high potential growth story.
Meanwhile, the core American Eagle banner, AE, it did return to growth. It posted a modest, but I think very meaningful 1% comp increase.
And that shows crucial sequential improvement. The driving forces there matter too. It was anchored by strength in denim,
Which they called out as the #1 category for Black Friday.
Exactly. But crucially, they also engineered a necessary turnaround in the men's business.
How'd they do that?
Well, it wasn't accidental. They noted they focused heavily on inventory discipline, so they weren't chasing weak trends. Instead, they centered on, high heat product, new denim silhouettes, core basics, and they executed these sharp, segmented promos that boosted traffic without just giving away margin.
Okay, so let's pivot to the cost structure, because this is where the story gets a little more nuanced. This operational success was achieved despite a major headwind.
It was. Gross profit dollars were up 5%, hitting $552 million, but the gross margin itself dipped 40 basis points to 40.5%.
And the primary pressure there was the U.S.-China tariffs.
Absolutely. Management quantified a $20 million net impact in Q3 alone. To give you some scale, that hit shaved roughly 150 basis points off the gross margin.
Wait, hold on. So if the tariff shaved 150 basis points, but the margin only declined 40, that means they found 110 basis points of offsetting efficiencies in one quarter.
That is the core operational insight for this quarter.
So what levers did they pull to absorb 2/3 of that hit?
Two main areas. First, lower international freight costs gave them a natural tailwind as supply chains normalized. And second, highly disciplined markdown management. Better planning let them sell more at full price. For experienced investors, that ability to just neutralize that much of a headwind, it's a huge green flag on efficiency.
It certainly speaks to management's control. Then we also saw SG&A selling, general, and admin expenses increase by a pretty significant 10% year over year.
Right, to $386 million. And this wasn't a margin accident. This was a strategic investment.
This was intentional.
Exactly. Management called it stepped-up investments in advertising. They are raising the spending baseline now to aggressively build brand equity for the long term.
Betting that the ROI from that brand positioning will outweigh the short-term SG&A drag.
That's the bet.
Which brings us to the core strategies driving these results and justifying that confidence. Let's unpack the marketing playbook, because it seems highly sophisticated.
On the AE side, the repositioning around denim authority is fully underway. It's not just about selling jeans, it's linking the product to cultural relevance.
Right, the great jeans campaigns with these massive collaborations, Sydney Sweeney, Travis Kelce's line, Coco Gauff, Jenna Ortega. It's not just sponsorship, it's tapping into different influential spheres.
And the reach is staggering. They specifically cited the combined Sweeney and Kelce campaigns generating over 44 billion impressions.
44 billion. I mean, for you, the investor, that's not just a vanity metric. It's a critical driver of digital traffic and top-of-funnel awareness that should translate into a lower customer acquisition cost over time.
And on the other side, Aerie is leaning hard into that authenticity message, the 100% real and anti-AI positioning.
Which powerfully resonates with its core demographic and sets it apart from all the highly curated fast fashion competitors.
And you can see the results in customer acquisition. Total customer counts were up across both brands, and loyalty membership grew 4% in the quarter.
And they said the digital traffic from these campaigns was a huge standout, right? Helping them get over 1 million new loyalty members.
That's sustained, profitable traffic. And beyond marketing, they're making serious capital investments in Omnichannel.
We saw the AI-driven virtual try-on tools, the 3D billboards.
The physical footprint is just as important. They're remodeling 90 to 100 stores. And crucially, management noted that these upgraded stores are generating comps nicely above the average.
So that CapEx is delivering immediate, quantifiable returns.
It is. And they're also pruning the portfolio, closing about 35 lower productivity AE stores, but planning for 40 to 50 new Aerie and Offline locations next year.
Okay, so with all this momentum, management felt confident enough to raise guidance, and they didn't just nudge it up, they accelerated the outlook substantially.
The Q4 outlook saw a huge upward revision. Operating income guidance was lifted to between 155 and 160 million.
And that's up from what, 125 to 130 before?
A massive jump, and it's all underpinned by the expectation that comparable sales growth is set to accelerate further, guiding for 8 to 9% comp growth in Q4.
Wow, that's a powerful run rate heading into the new year.
And it necessitated lifting the full-year target for adjusted operating income significantly. They're now targeting 303 to 308 million, up from a range that topped out at 265. This acceleration, despite the headwinds, is the major thesis shift for AEO.
Okay, let's talk more about those headwinds. The rising tariff issue is still a major variable you have to model carefully.
For sure. The Q4 guidance includes an estimated $50 million tariff impact. That means the full year 2025 impact is now projected to be around $70 million. That's a substantial cost to absorb.
And that impact doesn't just vanish on January 1st.
No. Assuming the current tariff structure holds, we should expect another impact of 25 to 30 million in both Q1 and Q2 of 2026. This is a quantifiable headwind that will affect year-over-year comps well into the middle of next year.
So what's management's strategy on pricing? They were pretty clear they are not just passing the full cost on to the consumer.
No, their approach is surgical. They're only taking targeted price increase shots, as they put it, where they're confident conversion won't be hurt.
And relying on those proven operational efficiencies to absorb the rest.
Exactly. The Q3 performance, where they offset all that cost, it gives their strategy a lot of credibility.
Let's also revisit that strategic ad spend reset. For the full year 2025, ad spend is expected to land in the mid 4% range of sales, right?
Up from about 4% last year. And crucially, initial plans for 2026 suggest this isn't peaking. They're pathing toward a sustainable 5% ad spend rate as a percentage of sales.
So for experienced investors, you need to model that 5% as the new baseline operating expense, a commitment to fueling that brand elevation.
It's the new cost of doing business to maintain that momentum.
And finally, on the macro front, they seem pretty confident. They noted they're not seeing the discretionary spending softness in the Gen Z consumer that a lot of competitors are reporting.
Right. They argue their product and campaigns, like that holiday gifting push with Martha Stewart, continue to drive demand across different age groups. They feel they're in a good pocket of the market.
That structural view brings us to the segment where we move from data synthesis to application. This is not financial advice segment, where we leverage the core data to deliver an outrageous but plausible trade pitch.
Our thesis is built around timing the exit of that tariff headwind. We'd suggest going long AEO, but targeting the payout around the Q3 2026 earnings report.
Okay, walk us through the mechanics of that timing. Why Q3 2026 specifically?
Well, the argument rests on operational competence meeting these cyclical headwinds. We know management demonstrated control by offsetting over 100 basis points of tariff pressure in Q3 2025.
Right.
And we know the company is guiding for this maximal tariff impact to persist through Q4 25 and into the first half of 2026.
So the stock right now is priced to absorb that 70 million headwind this year and another, what, 50 to 60 million in the first half of next year?
Exactly. The outrageous but plausible bet is structuring a highly bullish option play, let's say a call spread, that expires just after the Q3 2026 report. You're betting that AEO's strategy of accelerating growth via Aerie and their cost controls will result in a spectacular operational snapback in gross margin.
And the moment of that snapback is when they anniversary the worst of the tariff impact, which happened in Q3 of 25.
Correct. When Q3 2026 results get reported, that 150 basis points of non-operational tariff headwind from Q3 25 just cycles out of the year-over-year comparison,
And the market will react disproportionately once that artificial drag is removed.
revealing the true underlying margin expansion that's been driven by their cost leverage and the growth of Aerie all along. You're betting on the operational reality being masked by tariffs for 3 quarters, only to be dramatically revealed in Q3 of 2026.
So to recap this deep dive, AEO is successfully navigating a highly complex retail environment by leaning into targeted, sophisticated marketing and leveraging the massive growth potential of Aerie and Offline.
And the result is a significant and aggressive acceleration in guidance that really validates their long-term strategy.
The key watch points for you to track are twofold then. First, can the core AE brand sustain even that modest 1% growth rate through 2026?
And second, more critically, how effectively can management continue to mitigate the substantial yet predictable tariff costs until that comparison cycle shifts next fall?
Which leaves us with a final provocative thought for you to explore. Given management's firm commitment to elevating the brand through investments in AI and high-profile campaigns, and that permanent path toward a 5% ad spend baseline, how much of a premium should you place on the intangible brand awareness that buys them versus the immediate quantifiable drag on SG&A? What does being the recognized denim authority in the fickle Gen Z market truly buy them in the long run? Thanks for joining us for this deep dive.